Hello everyone, welcome back to part 4 of the video series for Course 101 Introduction to Futures Markets. And Course 4 is really going to be an introduction to Bitcoin futures markets. So, some very big news happened this year, 2020, back in January, that we're going to cover. But first, let's go through the disclaimer. Everything discussed in this video and all content on MarketMentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. So, Bitcoin futures markets is discussed in the book Introduction to Futures Markets. And to start, let's take a quick look at the contract specs. So, the contract symbol for Bitcoin on the CME is BTC. The contract unit, which is interesting, we'll discuss about this, is 5 Bitcoin, and that's defined by the CME Bitcoin reference rate, the BRR. That's how they price the contract, and that's discussed in detail in the book. And the price quotation is US dollars and cents per Bitcoin. The trading hours are Sunday through Friday, 6 p.m. to 5 p.m. EST, with a 60-minute break at 5 p.m. Eastern. So this is where contract unit size of 5 Bitcoin comes into play when looking at minimum price fluctuation, or the tick size of the contract. So the outright markets move in increments of $5 per Bitcoin, and that makes it $25 per tick, as there's 5 Bitcoin in the contract. And the pricing is $5 per tick, so that gives you $25 per tick. 5 Bitcoin times $5. The listed contract months, this is where things have gotten really interesting in 2020. It's actually a huge year for the derivatives markets, for digital assets, Bitcoin in particular. It's also a huge year for traditional finance stepping into the market. We had Paul Tudor Jones publicly state that he's actively trading the contract, and also James Simmons of Renaissance Capital, who's basically the grandfather of algorithmic trading and statistical arbitrage, or using machine learning to place trades. He has now enabled his fund to trade this contract, and it is lining up with the CME's expansion of the listed contracts. So prior to January 2020, the CME only had 2 listed contract months, the first 2 consecutive months, followed by a single December contract. And that has been expanded as of January 2020 to 6 consecutive contracts plus 2 additional December contracts. So that's big news for futures market traders. It's especially big news for liquidity providers and institutional capital looking to hedge market risk. From a liquidity provider perspective, market making expands as the listed contracts expand. There's more you can do in providing liquidity down the curve. That's discussed in great detail in Course 201, Building Statistical Arbitrage Trading Strategies. The next point here is termination of trading, the expiration date of the contract. Since Bitcoin is a financially settled contract, you can trade this thing up to the termination date, which is the last business day of the contract month. And lining up nicely here with the Bitcoin contract months, today is Friday, July 31st, and if we look at Bitcoin settlements, we're in the July contract is the front month, and since today is the last business day of the contract month, this July will come off the board at the end of the trading session. So, kind of building on some of our knowledge that we learned in part 3 on rolling contracts, you notice that the prior day open interest here for the July contract was 3,409 contracts open. So a good percentage of that is gonna roll during today's session into August or September, even further down the curve into October, potentially even into December. So this is a unique day to be analyzing the Bitcoin futures markets, and it's also worth revisiting what we've learned in prior video sessions, and also from the book. We can take a look now at the forward curve. So when this This chart was put together on January 30th, 2020. We had January, Feb, March, April, May, and June as the first 6 consecutive contract months, and we plotted the settlement prices for each of those contracts, and we came up with a forward curve, and we identified that that curve is in contango. So here is now an example as we talk Bitcoin markets of a Bitcoin forward curve. And we built further on that knowledge and learning how to create a calendar spread curve from the outright forward curves. So now we have the Jan-Feb calendar spread with its price plotted, and the Feb-March, the March-April, the April-May, the May-June. So we're able to visualize the calendar spread curve, and this again was this snapshot was taken on January 30th, 2020. So it was the end of the first month of CME Bitcoin futures markets containing 6 consecutive contracts, which is, as I stated, very big news. So to dive into the contract a little bit, let's first take a peek at the settlement tab one last time. So we're going to see July, which will be coming off the board. We're going to look at the calendar just to show everyone what I'm talking about here. So this July contract, the first trading date was on the 3rd of February 2020, and that was when the January contract went off the board, and July joined to make 6 consecutive contracts. And the last trading date will be today, 31st of July, for this contract. It will be coming off. And now we can take a quick peek. I took some snapshots from Friday, January 31st, 2020, the last trading date for January, when these contracts were expanded. And as we noticed, January was the front month contract, and there was June as the 6th consecutive contract. Well, on the first business day following that, that January 31st date was Monday, the 3rd of February, and we noticed that February became the front month contract, and July joined the board, which is the contract we are talking about currently. So we can get into TT and open up that contract and take a look. So we'll go to our MD Trader here, we'll type in BTC for the contract code, and we'll pull up the July market. So we see here there are bids and offers in simulation, and likely in the live market as well still, as the contract is live, and traders are, as we saw, still have open interest. So we can now take a peek at BTC August markets. This is likely where many of those traders will go on the roll. We can also pull up the DEES contract. I'm curious if there's anything in the book on simulation there. And for DEES, barely anything in the book, but some traders might be going here as well, just given the significance of a December position being towards the end of the year. And now that we have 3 futures markets up, we can quickly identify that these markets are in contango. So we see the near month trades at a discount to the deferred month, which trades at a further discount to the next deferred month. And that's a nice visualization of a market in contango. Closing out the December, let's pull up the calendar spread for BTC July 2020, BTC August 2020. We're going to cover a pretty big difference in the Bitcoin market structure for calendar spreads relative to what we've learned in conventional pricing through gold and crude oil. So we're going to click spreads here. We're going to find our July-August spread, and as we just discussed, the market is in contango. And going back to the book, we remember markets in contango have a positive slope because near months trade at discounts to deferred months all the way through the curve. But if we take a look now at the calendar spread, we might be a bit confused because we're seeing a positive number. And if we pull up gold real quick, and it's important to visualize this, I believe, so we'll take the time. If we pull up the gold VZ, the gold October, December markets very quickly, we can recall what the calendar spread looks like for a conventionally priced spread. And so there's our DEIS market. Now let's get the spread up there. GC spread. And we'll have to take a search for it here. So we're looking for the OC 20 DEIS 20 spread. I think it was on page 3. Yep, there it is. So this is the conventional pricing of a calendar spread. Leg 1, which in this case is GC OC 20, minus leg 2, which is GC DEIS 20. And when you have markets in contango where the deferred month is trading at a premium to the near month, when you subtract leg 1 from leg 2, it's going to be a negative number because the deferred month is trading at a premium. So why is Bitcoin, which is in the same market structure, contango, the deferred month is trading at a premium to the near month, why is the calendar spread positive? And this is tricky, quite frankly. And the upside to the trickiness is that where things are a bit tricky, there is opportunity. So for people to take the time to learn why the market is structured this way, they can potentially have a leg up on people who do not take the time to figure out why the spread is priced this way. So the long story short of it is the CME simply decided to structure the calendar spread as leg 2 minus leg 1 for Bitcoin, as opposed to gold and many other futures markets, nearly most other futures markets, where the pricing mechanism is structured as leg 1 minus leg 2. So just briefly go over it again. Bitcoin futures markets, the calendar spreads are priced as leg 2 minus leg 1, whereas gold, crude oil, copper, silver, corn, the ags, the calendar spreads are priced leg 1 minus leg 2 equals the calendar spread. So very important to understand the distinction there. There's many reasons one could come up with as to why the reasoning is not important. The fact that you must accept the difference in pricing structures and mechanisms is really all that's needed to move forward. So let's get rid of our gold markets and take a think on how to execute in these spreads for Bitcoin. If I am a trader who is long July BTC futures markets and it's July 31st, the first notice day of the contract, I'm going to want to get out of my position or I'm going to hold it through settlement and be marked to market. But if I want to maintain the position, and I'm assuming I'm long a July outright market for Bitcoin, I'm going to want to sell July to get flat that position and then buy August, or maybe go further down the curve and buy October or buy December. Either way, if I want to maintain a long position in Bitcoin futures markets through end of business on July 31st, I have to roll the position into a deferred market. And we can do that two ways, as we've discovered. We could do it manually by selling July and buying August to get flat July and roll that long position into August, or we can go to the calendar spread. Now, the prior video series and the book explains rolling positions through the calendar spread as what you do to the spread, you do to the front month. And to say that again, what you do to the spread, you do to the front month. So traditionally, if I'm long the front month, BTC July in this case, I would come into the spread and be a seller, sell the front month, buy the back month. But as we've just discovered, Bitcoin calendar spreads are priced unconventionally, where it's leg 2 minus leg 1. So in a BTC calendar spread, what you do to the spread, you do to leg 2. So one more time, in BTC unconventionally priced calendar spreads, what you do to the spread, if you buy the spread or sell the spread, you do to leg 2. So if I am long BTC July 2020 futures contracts and I want to roll into August, I have to be a buyer of the spread, because I am, what I do to the spread, I do to leg 2, August 20. If I'm buying August 20 in a calendar spread, well, then I'm automatically selling July because it's a relative value execution. If I buy August, I'm selling July. If I sell August, I'm buying July. So, long BTC July 2020 futures contracts attempting to roll through the spread market, I am a buyer of the spread because I am, in that case, selling July and buying August. What I do to the spread, I do to leg 2. Conversely, if I am short a BTC July futures contract and I want to roll that short position into August and be short one August 2020 futures contract flat July, I am a seller of the spread. I am I am buying July and selling August, because what I do to the spread, I do to leg 2. So again, if I am short BTC July 2020 futures and I want to roll into August, I'm a seller of the spread. If I sell the spread, I buy July, which gets me flat, and I sell August simultaneously, which maintains my short position through first notice date, or through the last trading date of the BTC July 2020 contract. So hopefully that's not too confusing. It's worth watching again, I'm sure, and maybe even a third time to really understand what we're talking about here. But to spice things up and to conclude the introduction to Bitcoin futures, I think it's worth taking a look at digital gold, which is included in the course, and that is a book that kind of talks about what is Bitcoin, why is it becoming widely accepted in traditional finance, why is 2020 in particular the year of institutional finance finally migrating into digital assets in some people's opinion. So if we take a look at page 12 of the book, we can see that Bitcoin is a financial asset and a commodity that moves far greater volatility than what most people are accustomed to seeing, at least historically anyway. I guess the past year or two have been a bit muted, relatively speaking. But as we see back to 2015, where one Bitcoin was worth barely more than $100, and now we see in 2018 or 2017 it peaked just at 20,000. And when this snapshot was taken, it was at 96.54. I believe the last mark on it was 11,247, somewhere around there. So if we look at this chart of Bitcoin and we then now look down at gold, we see what the difference in charts look like. Generally the same direction, just much less volatility, and we can kind of zero in on some of that volatility here on page 18. This is where I talked about at the beginning of the video that institutional capital that is highly respected in financial circles and in the mainstream, to quote unquote, is Paul Tudor Jones. He's a huge player, huge voice in the market, and he has publicly stated that he's beginning to trade Bitcoin through the CME Bitcoin futures markets. Now, one of the reasons for this is that CME is a regulated exchange. It passes the stringent compliance requirements of large hedge funds, and to build on that, the CME, as being the largest futures market place in the world, the largest hedge funds in the world already have accounts and are already very accustomed to dealing with the CME, and they have it worked in with their back office. And the list kind of goes on as to why the CME will become an important venue for institutional capital. But Paul Tudor Jones said recently, I believe it was back in May of 2020, not too long ago, that if you take cash and you think about it from a purchasing power standpoint, if you own cash in the world today, you know your central bank has an avowed goal of depreciating its value 2% per year. So you have, in essence, a wasting asset in your hands. And Paul Tudor Jones is kind of referring to the dramatic increase in the central bank, particularly the Federal Reserve for the United States, the balance sheet just kind of exploding through the past decade. We went through quantitative easing, and then now, as we move through the largest pandemic in 100 years globally, we've seen another cash infusion in trillions of dollars of cash hit the market. So Paul Tudor Jones is referring to Bitcoin as a hedge against inflation, or a hedge against US dollar inflation. Bitcoin is a finite asset similar to gold, although gold is a physical real world asset and Bitcoin is a digital asset. It is still finite in supply, and markets find equilibrium based on supply and demand. So if the quoted asset, if it's Bitcoin against the U.S. dollar, similar to a gold market being gold against the U.S. dollar, well, if the denominator there is increasing in quantity, a hedge on that inflation would be to long the numerator there, which would be Bitcoin, or you can also apply that to gold. And we have a chart here that shows gold through the 1970s stagflation period of the U.S. economy. This is adjusted for inflation, of course, and it's overlaid with the Bitcoin historical price. So this is Bitcoin 20,000. This point right here, and that's relative to gold adjusted for inflation through the 70s. So if you take a look at this type of analysis, you can see why there's some professional capital that really believe this thing still has, a pretty big second leg in front of it. And that's something that I don't know if it's being discussed enough, especially adjusted for inflation metrics. So good to bring it to front and center here. And then to wrap up the gold book, well, let's just take a look at CME Bitcoin futures average daily volume. So we see a positive slope here, and Q1 2020 really kind of knocked it out of the park, very similar to Q2 2019. And this is really expected to continue on an upward trajectory. I know with the tailwind of players like Paul Tudor Jones and James Simmons chiming in on the validity of the market, and especially the CME market in particular. It's only going to bring more confidence to market participants to get in the game in a sense, and liquidity provision will follow that shortly. We can also now look up here at BTC options market, which we're not going to go into too much, but they were launched. The options contracts were launched in January, or I guess at the end of 2019, January 2020, in parallel with the expansion of the futures markets, as the options markets settle against the futures markets. So as we can see here, April, May, the options open interest just exploded. And I'm talking, it's incredible to look at this chart really to see how much capital just kind of came in all at once things really started. This is right around the time of Paul Tudor Jones talking about the contract, James Simmons submitting to the SEC that his fund would like to have the right and to participate in BTC futures markets, and this is really the market talking here. This is some internals that are worth paying attention to moving forward. So that's a pretty good summary here of the Bitcoin futures markets and an introduction to them. In course 201, we go into depth on how to trade these markets, how to make markets in this complex, how to deploy statistical arbitrage trading strategies, and I guess what I can wrap up with here is an example of something that we are going to really dive into on the course 201, and I think it's very interesting for those who have an interest in what we're looking at here. So I have an algorithm that I set up, and I need to just triple check on the contracts. It's the SEP AUG contract, and I'm going to pull up the SEP AUG calendar spread. SEP AUG, or excuse me, SEP AUK. I believe that's what it was I was looking at here. SEP AUK. Oh no, it is AUG SEP. Yep, it is AUG SEP. Let's see. BTC AUG SEP. Okay, here's the listed calendar spread for AUG SEP. Here's my AUG outright. I'll put up a SEP here. BTC SEP. Oops. BTC SEP. There we go. So we're going to make SEP is our leg 2, August is our leg 1, and as we remember, this spread is this market's in contango. The spread is pricing leg 2 minus leg 1. So I built an algorithm here that can be a market maker in BTC futures outrights, and what I'm going to demonstrate here will provide bids in August and offers in August, and will provide bids in September and offers in September, looking to synthetically create this calendar spread, which is currently bid for 2 contracts at plus 80 and offered for 1 contract at plus 87. There's another interesting caveat that's covered in course 201, which focuses on reduced tick calendar spreads, which is, as you notice, the outright markets trade in increments of 5, but the calendar spread trades in increments of 1. There's ways to arbitrage that and create some interesting strategies, but for the time being, I am going to show you just a simple strategy that can provide liquidity to the marketplace through the calendar spread. And this is, now you can see I am bidding 80 and I'm offering 100, and I'm going to step my offer down just a touch to 90, and now you see my orders in the book. I'm actually going to back that up. This thing moves a bit. So let's bid we're bidding 80 and offering 95 in the spread, and as you can see, I'm populating offers in the book for BTC August 2020 and for BTC SEP 2020. I'm simultaneously populating bids for BTC August 2020 and BTC SEP 2020. So again, that's course 201 for those particularly interested in futures market trading and just understanding the market mechanics behind these statistical arbitrage trading strategies. I think it will be very useful, and I hope this presentation has provided some value to you on the fundamentals of Bitcoin futures markets. Thank you.